So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today I'm going to go through our ultimate quick guide to credit spread option trading. So credit spreads are what I believe to be one of not only the key building blocks of many of the great options trading strategies, but also can serve as a wonderful vehicle for those of you who are trading with a small account or even just getting started with a small account. So the beautiful thing about credit spread trading is that it gives you exposure to the high probability, high positive expected outcome of option selling with the defined risk characteristics that many people are initially attracted to when they look at long options like long puts and long calls. So with a credit spread trade, all you're simply doing is selling one option contract and buying another option contract, typically further out of the money than the initial contract you sold. And in exchange, you're taking in a net credit between the sale and the purchase of those two option contracts. So for example, if you have a stock that's trading at $100, you could create a put credit spread or a bull put spread by selling the 95 strike put option and buying the 90 strike put option below it. The difference between your buy and sell would ultimately create a net credit, which means you are an option seller in total with the contracts that you traded, and you collect a premium on order entry. Now, the beautiful thing again about credit spread trading is that it gives us, again, defined risk and defined profit potential, but allows us to move our credit spread further out of the money or closer to where the stock is, depending on what probability of success we want to target. And this gives us a little bit of a buffer or a cushion in our directional assumption. So if we think a stock is going to go higher and we trade this 95-90 put credit spread when the stock is trading at $100, we've got about a $5 cushion and have the potential to make money even if the stock goes down by $5. And so that margin of error is really where this starts to become a strategy that is more efficient in performance and capital use than just regular purchasing of stock or shorting of stock. To use a credit spread example on the other side, where you would sell a call credit spread or a bear call spread, you would essentially be selling the 105 call option and purchasing, for example, the 110 call option, again, assuming that the stock is trading at $100. You'd still take in a net credit on the sale and purchase of these two contracts, and that would be the premium that you receive on order entry. You're hoping that the stock stays at its $100 level or goes lower, but even if it goes higher up to 105, you still have an opportunity to potentially make some money. So again, the reason I like credit spreads so much is because of the defined risk characteristics, because you can target whatever probability of success you want. You can create credit spreads across ETFs, major stock indexes, top stocks that you want to trade, and get exposure very quickly for a small account without having to outlay such a huge amount of capital in an inefficient manner by purchasing stock. So hopefully this helps out. As always, if you have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.